Right. Happy Sunday. How are you all doing? Right. Let me see here. Chat. All right. Can you write where are you guys from? Where are you attending from? You can write here in the chat. You can also ask questions there. Ah, hey, Miami. Hello. I'm usually in Miami too. All right. Not today, but let's give it one more minute and then we start, okay? We're gonna talk about the colors that I opened on a lot of my positions, and I will explain everything from A to Z, how to do it, and how you can protect your portfolio, especially going into very weak month of September. We have a lot of economic news, and if you feel like a little bit nervous about everything, then I will show you how you do it very safely, and it costs literally nothing. That's how you structure the colors. So if you have any questions, you can write here in the chat and or in the Q&A. You see it down below, and I will reply them at the end. Just when I'm explaining, I don't want to be interrupting my thoughts, right? I will share the option chain with you, and I will show you the colors that I opened. All right, I think we will start soon. So let's do that, so we don't waste your time also. So I'm Leah. I'm trading and educating at the TMAT, trading mindset and data. I've been trading for 6 years, investing for 15. And today I want to talk about how you protect your long-term positions in uncertain times. So the market has been beautiful. We have beautiful trend. The market is in all-time highs. But a lot of us are asking, why is market going like this? This is historic rally. Some of us are a little bit nervous. And now what do? You sell your positions just to see that the market goes higher. That's also not that ideal. Secondary, you have to pay tax after you sell. If it's a short term or maybe even long term, you pay tax as well. You might not want to sell your positions, right? It's not always just black or white. I sell, I buy, I hold. So there is a great strategy to protect these positions, and you can do this on ETFs or individual stocks, and it's called the collar option strategy. It's very simple. Of course, you can just buy a put, right? We all know what puts are. Puts are going contracts that will give you the right to sell your shares at a certain price. But the problem with puts is they mostly expire worthless. You lose money. Doesn't mean that the stock is going to go down, and you just buy those puts. They cost a lot as well, and you're just giving money away speculating, right? The market keeps going higher, stocks are going higher, your puts are costing a lot. It's an expensive insurance. So what you do, you structure a so-called collar. So let me share a chart with you. Collar means that you sell a covered call and you buy a put. And I did it on 5 companies last week and last 5, 6, 7 business days, as I was opening them not in the same day, but different days. And you can see here, I'm sharing my chart with you. I did color on AMD, Anet, Nvidia, Hood, and Coin. These are all my long-term positions, all right? So here on this chart, you see where I opened these colors. So sorry, I don't know, this one disappeared. So AMD is 200 and 155, right? 200 and 155. So now when do you open those? Be careful with those. Ideally, you open color when the stock is up, because then you get the highest premium for the covered call and you can sell them higher. And I will explain to you everything in detail how. But number one priority, you want to sell color or open this color option spread, I would say, when the stock is up, or the ETF. It doesn't matter what you're opening it on. You want it to be after a big rally, after many green days, 2 free green days, in all-time highs or reaching a new, let's say, resistance. These are the criteria. You do not want to open it on a down day, because you're going to get nothing for the covered call and you're going to pay a lot for the put. You want to do it a different way. You want to do it on a day that's strong, green, and you're going to get a lot for the covered call, right? And now you take the money from the covered call in the same time and you will buy for the same expiry the put for the proceeds that you got for the covered call. All right. So on AMD, on AMD, ideal day to sell covered, do this collar would be on, you see here, July 30th or August 1st before we started falling, or again here on August 13th, right? So it's like a nice high, 2 free green days, big move, big gap. And you're like, you know what? I think we're going to most likely retest. And then you look at the option chain. So let me share with you the option chain. All right. I will show you my broker right here. All right. So I use this for option chain. All right. I love to think or swim. You can use Power E-Trade. You can do interactive brokers. I'm trading under LLC. And when you trade under LLC, most of brokers will charge you for in real-time data. Schwab now bought Thinkorswim, so I don't pay anymore for the data. But that's why I have different brokers. I'm using the one I pay only for one, because otherwise it's for each you pay $30-$40 every month for the data, right? Otherwise it's 15 minutes delay. So let's say I'm using this. This is a beautiful option chain. I don't need anything else. I look here, I can execute in any other broker. Then it's very quick, right? So I looked at this September 19. I want to do at least September 19 or September 30th, and we can look together, right? Why? Because I want to make sure that I'm covered and safe until mid or end of September. Again, we have so much stuff happening. We have this week is the symposium in Jackson Hole, right? 21, 22, 23. Fed are going to talk about the labor market, what's happening. Then we have NVIDIA earnings next week. Then we have NFP on the 5th. And then we have the FOMC. I have all this calendar here in our Discord. We have on the 11th of September, we're going to have the CPI inflation data. And on the September 17th, we have FOMC meeting, my friends, when they're going to have to decide. And remember, if they skip the cut in September, that's going to be a disaster for the market, especially if market is going to price in by the 5th and 11th that we're going to be cutting rates. And if not, it's not going to be any good for the market. So right now, I think the market is pricing in 92% chance of cut. So pay attention. That's why I felt a little bit unsafe with the market. I said, we might go higher, but if not, I do not want to give my money back. I'm up a lot on those positions. Let me open in September 19 and let's go. Option chain delta. This is number one thing I look at is the delta, which also means one of the meanings that is very important for now. You can read on what else it means, but for now, not to confuse you. What is the percentage that this strike can happen until this time? What's the probability that this will happen? So I look at delta around 25.20. 25 is like my average. So if there is nothing on 25, I would do 22 or 28. So I decided to go for 200. And that's a 22 delta, so there's 22% chance that this price will be in the money by that time. Right now it's out of money because it's 175 now. So this is at the money and 200 is out of money. So I'm going to get about 279 or $277 for this contract if I sell it. All right. So I sell it and then I look on the put side, and for that money, I'm able to do 160 put or 155, 160. These numbers were a little bit different then because I was doing it on Wednesday here on this day, which was a different scenario. But now, just that you understand when you do it next time, now you would be able to buy 160 for that money. All right, you sell it for 277, let's say, and you pay 279 or 280, so a couple of dollars more you would pay for 160. Done. Your position then is locked for September 19th. And again, let's share the chart. And you are safe to 200 and 160 in this case. I have 155, but it's 160 because again, I'm saying I was selling it on the up day. So I get more for the 200 covered call, right? You get less now if you would do it on Friday because you already dumped. So now I'm safe. I don't have to do anything. So if you would do it now, you could do 160, 200. So what happens now? You have the collar, you feel safe until the stock is not till to 200, nothing to worry about. The downside of collar, we have to talk about it now, is that if the stock gets by 19th of September to $200, I'm going to have to sell my shares, right? So that's going to be my problem. Then you can look again at the option chain. Okay. But again, do you care if you bought AMD? I bought AMD for $100. I do not really care if I sell it for 200. I made 100% of my money. Okay. Again, the tax comes to play and et cetera, et cetera. But I'm fine with making 100%. Just think about it. I'm much more happy to be called away and make 100% and feel safe for the next month and a half and chill. And I should be living here in constant thinking, okay, what if this happened? What if the market? What if that? I don't care. Because if the stock dumps, okay, I'm going to make money, not only on the covered call. So I'm keeping this $270. But if I get in the money and the market would take a nosedive, I'm printing on this put as well. And it cost me zero. So I have free protection on my position, which I really love this strategy. Honestly, it's the best. And it's especially good for holdings that you had for a longer term. And you can always roll this. You can always roll to higher strikes if you want. Now, let's say I will close it when? I will close it about 2 weeks before expiry, because then the theta will kill everything. It's going to kill the profits for the puts. Of course, it's going to also kill the profits for the strike. But another way, I would close it about 2 weeks before and rethink if I feel still that, okay, we have some bad news. I don't know, I might open another strike and another collar, right? Fresh one. Or if we would take a nosedive quickly and the stock dumps, let's say, to at the money and very sharp sell-off, then I would close, because then the implied volatility kicks in and I'm making nice profits on the puts. I'm making profits on the covered calls, and I would close it then. All right, so this is pretty much it. It's very safe, but let me share the option chain with you again. Another criteria I like to look at is here, expected move. So by September 20, AMD is expecting to move about $20, sorry, not percent, dollars. So it is the bell curve 68 something percent, right? It doesn't mean it's going to happen. It might be outside of the mean in the middle that we have, and it might be more, right? And also you don't know it's plus and minus, but I'm just looking at the option chart and expected move, and then I go back. All right, let's go back here. This is my thinking when I do this strategy. I'm looking at AMD here. So 185, when I open, it's 205. Okay, so I'm a little bit in that possibility. If it would go up to 205 and down, look, 185. So I'm a little bit there outside of the put, but of course you're making money on the put when it happens fast. Before it even hits the in the money, right? You're going to start making money on the put. So right now I am up on hood. Let's look at hood. So I'm up on hood. I am up on coin tremendously, because coin I opened on this day, which had this spike, and I'm like, I don't know. It's in the. Sorry guys, I have all these things, all these deliveries coming, so I have to be letting them in. Sorry. So I was opening it on this day, and now I'm up on coin. I tell you exactly how much. So I have 290 put, because it's right here on this support. So if it dumps, it's most likely going to go to 290, 295. And I have 410 covered calls I sold. That's really far out there, guys. I have 410. If we get another push in crypto, we get to 410. God bless me. I'm so happy to sell this coin for $410. Like, I don't really care, because I've bought it here at this breakout of this little flag here. This was my entry right here, as you can see, around 260. And I did not sell here, which I didn't want to sell. I wanted to hold it for longer. So now I'm like, okay, if it gets to 410, I will sell. So coin, I'm up now on my position. I'm up 35% on the put and 47% on the covered call already after 2 days. All right. So I could be even closing now, but I don't like the chart. I don't like coin. I'm going to keep the protection. And this is for September 19 as well. All right. So that's pretty much coin. Let's look hood. Hood, I have 140 covered call. And again, like I'm in this stock for so long that I really don't care when I get called away by 140. And again, remember, if you have 1,000 shares of wood or 200 shares, you don't have to protect all of them. You can protect just half of it, and you can always do different strikes. You can protect half of it, and then if you see that the market keeps going higher, you can sell higher strike calls and spread it out. You don't have to always do all of them, even when you're selling covered calls, just pure covered calls without the puts, just for profits. You don't have to always say covered calls at the same strike for all the same shares. You can spread it out. Okay. So Nvidia, I opened as well because Nvidia had also a huge run. My entry on Nvidia is at 110 right here. You see, this is pretty much my breakout trade. 110, this was my stop. And I'm still in Nvidia, and I have now caller 160 and 205. Nvidia likes to do nothing on earnings or fly, and we'll see what happens this time. It's on the 27th, if I'm not mistaken. What is here? 27th. Yes, Wednesday 27th is Nvidia earnings. And look, expected move. Let's look together on expected move on Nvidia. I'm sure you guys want to know too, because this is going to be huge. I'm very curious what Nvidia is going to do. Let's check. Nvidia, the August 29 week expected move is 15. All right, dollars, not percent. So let's go. And we're gonna look. All right. So I think I'm fine. If we get to 5, I will be happy because I'm gonna be making a lot on this trade, so I don't really care if I get called away. But always remember when you do this, you have to understand that if you get called away, you should be fine with that, because a lot of times people sell covered calls and then the stock gets there and then they're freaking out. They're buying it back for a lot of losses. No, I don't want to actually sell. So make sure you're fine with that, because if it happens, you have to sell the shares or you're gonna buy the covered call back for a lot of money. You're gonna lose. This covered call, you can be paying $1,000 for that call, because a lot of times these selling options, there's a high probability you will succeed and you will make money, but when you don't, it can be 3-4 times what you actually got paid for, especially when you're buying back options they got in the money. Okay, so now let me ask if you guys have any questions here, please. You can ask here in the chat if you want me to answer anything about this strategy. It's pretty easy. Another one I have is Anet. That's it for now. Anet, I have 149, 129. A color. I'm like right in the middle now. We'll see if it holds. If not, if it breaks this level here a little bit in the gap, then I think we go back down to 120. Hopefully not. Again, I'm in at 99. This is my trade here. Breakout of this chop here was my entry. And I don't care if I get called away. Again, it would be just like the taxes. I don't like the short-term capital gains. But again, always think about that too when you trade. If you want something, I mean, this is more investing, so think about when you're selling covered calls, what happens. You're gonna have tax implications. All right, something to remember. So okay, let's see here if you guys can chat here. If you have any questions, please ask. If not, then I will wrap up this quick phone call about callers. 11 people. Oh. All right, so seems like this is very clear to you. Okay, yeah. It's really like, I'm surprised a lot of people don't know about this strategy, and it's super easy and it's super nice. I mean, financially it's not too risky. Even when you say the risk is you will have to sell the shares, but I mean, look, if you sell them for so many gains, nothing wrong with that, right? It's much better than sitting there and seeing that we have market drawdown and you were up 100% or 80% on a position and you're back down to zero. I mean, that's really frustrating. So I might as well be called away with the 100% gains in the worst case scenario, right? Or 50% or whatever it is. This is a lot of money. So we have to really think about the pluses here. Okay, cool. I mean, that's pretty much it. I will send the recording out to you all who were here, and other people they signed up. And I will wish you a wonderful Sunday, guys. Get ready. This will be a crazy week with the symposium. And now I think they're talking about discussion with Zelensky on Friday at the White House. I'm not sure. I have to look into it. I try to enjoy my weekend, but that will be a crazy, crazy week all at the same time. And then we have, yeah, NVIDIA earnings. So we'll see what happens. But please be careful in September, because really, if the market is pricing in by the 5th and 11th of September, and you can check it on the Fed Watch tool, how many percent now you have. Let's look at it together. Here is the link. I will send it to you in the chat. Okay. So here you can see what the market is pricing in right now so it's 84.6% right now that they're going to cut rates in September. It was 92 last week. Now it's 84, and this is constantly changing, right? So please check on September 5th and 11th what the market is pricing in, and then you will see. We will have the farm NFP, as I said, non-farm payrolls, and then on the 11th the CPI, and this is going to be adjusting. So we'll see by then what the market is pricing in, and then we will be careful depending on that. Right? If the market price is in that we are not going to have rate cut, if they don't cut the rates, there won't be too much of a reaction. And then if they do cut rates, then the market will be reacting. So there is one question. With a collar, is there a cap on your profit? Yes, of course there is. The cap on my profit. So, well, look, the collar ideally doesn't cost me anything, because as I said, I try to structure it based on the delta 25 to 2025, sometimes maybe 27 delta, but then higher the delta, that's like a probability you're going to be called away. So I like to keep it below 25% and take the money and buy the put. Sometimes I pay extra 50 or $100 per collar to get a higher strike put, right? Because if you go closer to the money with the put, more expensive it's going to be. So yeah, the cap there is the cap on the profit. No, because with the collar, with your shares, yes, because you will have to sell your shares at the covered call strike. All right, that's the cap profit on your shares. With the collar, you're gonna make if it is below the covered call strike. All right, you're gonna make 100% at that date of expiry for the covered call. But with the put, you don't know, because if the stock starts falling, it's treated as a regular put. So you're making money not only on the covered call that you sold and you're keeping 100% of the premium at some point, but you will be making the money on the put as the stock keeps falling. So if, God forbid, there is like SPY tanks 2, 3, 4, 5%, and you have all these covered calls, all these collars, you are printing on those because you're making money on that put like any other put. And another thing to remember, when I was buying those, VIX was like 14, super low. So let's look at what is VIX right now. So remember, the moment that the market starts falling, okay, you're gonna have increasing VIX, and your puts that you bought are gonna be increasing in value tremendously because VIX is gonna be increasing, and price of the option is also this. So look, it was 14, about 14, between 14 and 15, not even, when I was selling those and buying those puts, right? You sell call and buy the put. So remember, if the market dumps and VIX suddenly is 24, you're going to print on the put and you're going to keep the premium. So the put is unlimited. You don't know, undefined gain. The collar is, the covered call is defined gain, if it makes sense. Yes, of course. Would this be a good way to structure protection on indices? Of course, yes, with spreads, since I don't own 100 shares of SPY. So what you can do there, you can do certain similar. So you sell a covered call on SPY, let's say, or QQQ. But because you don't own 100 shares of SPY, you might want to protect yourself in case that the stock, the ETF, the index is going to fly. So you, let's say, let's look at SPY together. I will explain to you how you can do it, and you can do this with any shares, right? So SPY is like for 643 now, okay? So you can say, you know what, I'm going to sell 660 covered call inspire, or I don't know, let's look at the option chain. Let's say 655, 660 covered call. But because I want to be safe and have defined the risk, right, in case SPY starts flying, who knows what happens? The war is resolved and they've cut the raids and everything is great and amazing and SPY starts flying. You don't want to lose a lot of money on the covered call because remember that this is basically naked call. It's very dangerous. It's one of the most dangerous strategies you can do because you have undefined loss. So you sell 660 and buy 670. Okay, and then you have the risk. It's the middle minus whatever you got for the spread. Okay, and then you can buy a put. So it's going to cost you a little bit more because of course you're getting less money because you are selling a spread, not just a covered call. But you can take these gains and use them for buying a put on the index, right? So you can also sell. You can also buy a spread as well. So you can sell a covered call and buy a covered call higher. So that would be a short call spread, and then you can buy a put and sell a put lower as well. So you don't pay as much for that put. So you're gonna define your gain as well. You're gonna if SPY starts tanking, you're only gonna make money on that spread. But that's another strategy you can play. Absolutely, yes. Another question is, can you show us how you would set up, you're welcome. How would you set up your color on Hood? Of course, yes. Let's look at that. So let's look at Hood. I love this stock. It's beautiful. It did really well. And so I was selling it also on Wednesday or Tuesday, one of those days, because again, we were rolling. It was a little struggle there. And I'm like, let me protect my gains because I'm up a lot on this stock, way over 150%. And I look at the option chain. So let's look together now. So Hood. And I will look for September 19th, again, the monthlies, but you can do even September 26th, let's say the weekly, doesn't matter. Let's say from now it's already August 17th, so let's do longer. Let's do September 26th. And now you look at, by then, expecting moves 20. You're gonna look at delta here. Delta 30 would be 130. That's too much for me. I don't want delta 30. I would like to have delta 19. It was a little bit less back then. 19 is a little bit low, but you can do that also. 140 is the strike. So there is a 20%, 19% chance you will have to sell your shares for that price of $140. You will be getting also, it's not as liquid, so the spread is really ugly there. That's another thing you have to look at, right? So it's bid is 201 and ask is 249. Wow, it's crazy spread. So the 135 for that is even more horrible spread. Oh my gosh, look at this. This is crazy. So you want to kind of, you have to do limit, okay? Don't do market because they will give you the most horrible price for selling this. You're gonna get only $201. So do like 220, let's say, go a little bit closer to the bid, but do let's say 220. I would try to get fill on that. Or I would literally go, wow, this one is even worse spread, but I would do here about $3.50 I would try, okay, to get. And then you look at the other side for delta 30, and you would do delta 30 here, 105. But you could also go lower because you don't get so much money for that, right? So you would get here about $3.50. You can go to 201 would be kind of what I would try to go for 100, 102 as a put, okay? So that would be delta 23, 24. I would try to get also limit order here to buy this put for about 370, 375. So here you would get 330. So you would pay about $40 for this one. Again, you can go a little higher, but that way you are protected to 102 if it goes below. And again, if you have next week or two, you have a dump and you still have a month to go, Theta is not killing you yet. You can close it with profits, both of those, right? So that's how I would do Hood. And I did Hood, I did 95, 140 back then. It made sense for me on that day I was opening it. Now is a different scenario, okay? Probably, yeah. That's usually that case. Yes. So the better spreads are usually people trade the monthlies. You can do that too. So let's look at the monthlies. I have September 19th, 95, 140. That's what I did. Let's look at that now. How much would it be? So 140 is covered call, 140 now is delta 18 only, so you could do 135 because we took a little bit of nosedive there. That's why you get now more. You have delta 23. When I was doing it, the higher delta was from 140 because there was higher probability we will reach the 140 by that date. Since we took a little nosedive last 2-3 days on hood, not bad, but we did. It's different delta, so you could even do at this point 135. And again, yes, the bid and ask is not that bad. So you could probably get 260 for this contract. And then look at the put side, 260, you could do 100 now and pay a little bit, $40 for a contract, 40, 45. Or you can do 95 and cover the whole thing. But 95 is only delta 15, so it's not going to protect you as much because you will be only having 50%, 15% chance, right? 1.5 that it's gonna get there in the money, which is good. But I think you would be better off with 100 or even 105 and pay a little bit for it, right? So you don't have to always be cheap and like try to, because it wouldn't make sense to buy 15 delta put, right? It's like a wasted money. Then you might as well not buy any. But you might as well buy 100 or $105 and pay a little bit for that put and then be super protected, because if we are now at 114. If it only goes down $10, which for high beta stock is nothing, like you're already making a lot of money on that put. So, yeah, okay, that's pretty much it to this strategy. And I'm going to now wrap up because I have to prepare for the market for next week and look at some charts. And there is a Q&A. Covered call for Tuzub idea. Ooh, covered call. With Tuzub, honestly, I would be careful because this stock is not trading as much on technicals. This stock is going to trade on news. And I have a lot of shares too. And quite frankly, if there is news announced on this stock is going to fly and you're going to hate your life. And I don't even know if they have option change opened. Let me see. This is no, they don't have options. They don't have options. I would just wait with this one. Honestly, this stocks, I have a lot of shares also. I have about 4 or 5,000 shares of this one. I'm just gonna wait because it's the one of those stocks they will just suddenly get news and they will fly like BMNR, and then you're gonna be hating your life that you're stuck in covered call. So yeah, it's better that way. All right. All right. What else? Any more news? Any more questions? And then I will wrap up. Questions? All right. Everything answered. All right, guys. Well, be safe and play around with it next week. I think we're gonna have very volatile week. I think so. We'll see. I'm excited. All right. Bye bye everyone. Thanks for stopping by. It was really fun. Okay. Thanks.